Welcome to the insurance series. I am William Freitas from Confio Insurance, and today we've got Ian Markus from Debtor Protect. Ian, welcome.
Thanks for having me today. We're looking forward to it.
Tell us a little bit about, one, your background and Debtor Protect. Naturally, everyone we bring on the show, we're keen to sort of get a feel for what had you be in insurance, because that's always a colourful story for one. But also, we're keen to chat about trade credit insurance today. That is your specialty. And so it's often an area of insurance that I think many businesses don't necessarily understand. And so it's something that we'll dive into. But naturally, let's start with a little bit about your background and how you got into insurance.
No problem. So, Ian, I've been originally left school and trained as an accountant and spent a few years working in practice accounting roles and then in corporate accounting roles. Went overseas. Qualifications in accounting weren't as recognised over in the UK when I was there for a couple of years. So from there, started actually working in recruitment. So spent in labour hire, spent a couple of years working in the UK in labour hire, enjoyed that, came back to Australia, started working in labour hire. It's a fairly sales-driven service type role. So from there, moving into a niche area like credit insurance had its appeal, and I guess worked quite well because there's an element, I suppose, of accounting. Most of my clients that I deal with are CFOs or business owners that have an understanding and want to talk accounting lingo and have accountant problems, of which credit risk is one. But it's also coupled with that service side of things, or creating a solution to a problem, I suppose, which is an element of sales in that, but also that's where the labour hire recruitment background came into things quite well. So started working in credit insurance around about 13 or 14 years ago. Spent 4 or 5 years working with a large specialist broker, very niche role in sales. 9 years ago, launched Debtor Protect, which is a specialist trade credit insurance broker. So I identified a need in the market because the product itself, when we start talking about it more today, you'll see there's a lot of moving parts with trade credit insurance. And I do think it makes real sense to have one point of contact that can handle all those moving parts on a client's behalf. So when a client's ringing up and engaging and trying to get the most out of their policy, there's somebody there who can empathise with all different aspects of their problem. So Debtor Protect was launched 8 or 9 years ago to try and fill that need. Since then we've grown. We've got a staff of 3 now. We service clients across Australia. We service clients in New Zealand. We deal with all insurers in the market. We deal across a number of industries. We do a lot of construction work. We do transport work, a lot within labour hire, and a lot of businesses that supply to retail. So I'd like to think in that time we've sort of delivered upon that, and we're really trying to grow. And we've got a market at the moment that's giving opportunities for us to do that. So looking forward to telling you more about it today.
And before we dive into what is trade credit insurance, I'll just add, what I love about insurance is that our experience is so varied. Like you said, we get to deal with businesses in various different industries, whether it's retail, labour hire, construction, you name it. It gives you a really good broad perspective on how the market is doing generally, the economy is doing, I would like to think. And particularly in your space, I think you can probably, and we'll jump into what the product is, but you'll get a good feel for how the economy is doing, because you'll see how payments are tracking and sort of claim activity, right? So let's start with trade credit insurance. Tell us a little bit about what the product is and what it covers.
Yeah, so in its simplest terms, trade credit insurance is cover against customer insolvency or default on bona fide debt. So what the definition of insolvency is when a business no longer has the ability to pay its suppliers for the money that they owe. So in Australia, that legally becomes, or in the credit insurance world, that legally becomes when an insolvency practitioner is appointed. So just to really break things down into its simplest terms, the business ecosystem of Australia is that most business-to-business transactions take place on a credit basis. So a builder goes and puts a roof on top of a big commercial building. A business supplies clothing overseas, or a box of prawns goes into a cafe. All these transactions, when the roof goes on top of the building, the roof is not going down to the bottom floor asking for his cash. The builder is raising an invoice to the builder. The roof is raising an invoice to the builder, and the builder's got 30 days, 60 days, or whatever the agreed terms are to pay that. So the ecosystem around Australia for Australia businesses, they are operating with exposure to actually getting paid. Now, that doesn't always happen. So it doesn't happen for lots of different reasons, but one of the reasons it doesn't happen because the customer that they're working for comes across financial problems. And if that happens, that's where trade credit insurance comes in to protect clients. So a policy, there's a market out there, but in a nutshell, a policy will protect clients for 90% of what they're owed. Now, what's important you need to understand is it doesn't cover you for disputed debts. So we deal with customers regularly that will say, my client hasn't paid me because they've said X, Y, Z wasn't done as per the contract. That's not a reason to come to me. If that was an insurance product that was out there, insurers wouldn't be able to pay their own rents anymore. This is very much a product that deals with the financial risk of your customer not being able to pay you what they owe you and going insolvent.
And so that, just to clarify, I think you mentioned earlier, so the clincher to that is that they must be insolvent. So there must be someone appointed to manage that insolvency. Is that correct?
Yeah, look, 90% of claims are paid that way. There are clausing in policies that protect clients for protracted default. So that's when customers have waited 4 to 6 months normally from the due date of the invoice to elapse. The debt's not disputed. It doesn't always make sense to wind somebody up. The way the Australian insolvency laws are set up, it does take time to wind somebody up. So insurers have reacted to that and they've put in place protections that can say, if we can see that a debt's not disputed, it may not make sense to wind that business up. It's not in anyone's interests. We'll pay you a claim on the basis of you waiting out a waiting period and doing all you can to get that money back. So it's not as black and white as insolvency is required because that's not always in everyone's interests. In a nutshell, that's what the product's designed for, but they've had add-ons to protect businesses outside of that.
And so in that event, does the insurer then step into the client's shoes and assume their rights to then
Correct.
not dispute that, but to follow up that payment?
Correct. So the insurers will then pay a claim and then everyone's still interested in getting that money back. So it's the insurers interested in getting the money back. Our clients are interested in getting that money back. The insurer will continue chasing that. Now, they'll be chasing that using collection agents. They'll be chasing that using solicitors. All those costs are covered. But the process of continuing to chase that, look, in a lot of cases, the way the laws and the rules set up, it can get to a point where there's no point chasing anymore. So the insurers will pay a claim and then not chase because, unfortunately, depending on who you ask, the way the landscape is out there, quite often it is stacked in the favour of the debtor, the person that owes the creditor the money. If they simply want to go AWOL or they don't want to respond to legal letters, there then gets to a point where you have to start spending money to chase that money. That can be quite expensive. So it's where it gets to that point, it always becomes a commercial conversation. But the saying, throwing good money after bad, fortunately, that's where insurance policy can protect clients because ultimately where they're in that boat, the insurer will pay a claim and then it becomes the insurer's problem. But generally speaking, they will continue to pursue debts on clients' behalf.
And the time and energy that it saves for clients as well, right? Because it would be a huge drain on clients' businesses chasing debts, right? Whether they then want to source legal fees, whatever it might be, or some legal advice to then chase those debts, it can really take them away from income-producing activities, right? So it kind of makes sense to transfer that to an insurer.
Yep.
Out of interest, from a process perspective, what requirement is on the client to facilitate that I guess, follow-up from a debtor? Do they need to be involved, or once payment is made, is it up to the insurer to take that from there?
Well, it really depends on individual circumstances. Ultimately, what clients have to do with this product, at the end of the day, there's an expectation as if they will act as if they're uninsured. Because the reality is each case is unique. Each case you're getting different messages back from the person that owes the client money. So the solution's always going to be different. Now, they will work. The good thing, I suppose, about having a policy is they're working in consultation with an insurer. So these insurers that they're working with are giving them advice, and they do this every day of the week. They are working strategies to get money back. So from a perspective of what's required, there's not a whole lot. The insurers don't want to put rules and regulations in here to scare people off. they will take as much of the work as needed. And if the client wants to outsource the majority of that legal and formal collection chasing process, they'll work with the client to do that. If the client wants to remain as involved as possible, as they've got a commercial relationship to protect, the insurers are going to appreciate and respect that as well. Because ultimately everyone is working towards the same end goal, which is getting the money. And the claim is only there really as a final backstop to protect the client so they can keep cash flows going.
You've raised a really good point. With any claim insurance, ultimately, if the insurer is stepping into the client's shoes to recover funds, it can sometimes put a bit of a strain on the relationship with that client, that commercial relationship. And so it is important to be aligned with an advisor who can step you through that process. And you kind of mentioned an advisor who can manage the day-to-day of utilising that trade credit insurance. What does that look like?
Well, for us, we're here to really ensure, we're here for a few things. So ultimately we want clients to get the most out of a trade credit insurance policy. There are a lot of benefits that can be obtained by customers having this type of policy, but we really we exist to be that intermediary, to speak the language of the insurance companies and speak the procedures and process of the insurance companies, dilute that so the client understands that, and then get a harmony there. So really where we sort of see our role is to act in the interest of our clients. So what our clients want to do, if it's protecting a commercial relationship and they believe that they've got true understanding that a debt will be paid by going easy on them and not necessarily going down a heavy-handed legal route, making sure that those representations are properly looked after, because ultimately they've got those business relationships. But it's also making sure clients understand it's a balance at the end of the day. Businesses need to be responsible. They can't, in the current environment especially, where there's a lot of tax debt's high. Tax debt's 50 billion, which is more than that's the biggest creditor in Australia. This is the tax office. Where they're owed so much money, businesses have to act responsibly and they need to be operating within tight measures. And sometimes using an insurance company can be a good third-party blame for that. So if you've got a long relationship with a customer, you've served them for 20 years and all of a sudden they start being very slow in paying you, the conversation you can have with them about using the insurer to blame. Say, look, the insurer, unfortunately, because we're insured, requires us to take these next few steps, can soften and can help you manage that relationship better when it comes to chasing them. So each case is so unique. We aim to understand what the client wants to achieve and we advocate for them to get the best result for them.
And so I know we're kind of only touching on trade credit insurance. It's probably a part of the credit insurance space, right? There's bonds and the like that we can touch on a bit later on. But talk to us about the process of obtaining trade credit insurance. What is involved? What information does the client need to come prepared with?
Yep.
Talk to us about that.
What insurance? A lot of the principles are the same for any insurance that businesses look for. What the insurance are really trying to get a gauge of is the size of the business. So this type of, when we're talking size, we're talking turnover. And when we're talking turnover, we're talking insurable turnover. So what that is transactions a business will do in a year on credit terms. So some businesses will trade on cash, that's excluded. Some businesses will take deposits, that's excluded. Insurers are really interested in how much transactions are we going to be insuring over the next 12 months. Then they'll look at the other basic principles. So what they'll look at, they'll look at things like, who are you dealing with? What sectors are you in? What industries? What type of customers are you supplying to? So in terms of looking for financial information, they're not going to be going into your full audited accounts. They're not going to be looking for profit and loss and balance sheets. They're simply going to be looking for receivables ledgers. So receivables ledgers will give an insurer an idea of who are they dealing with, what type of customers they're dealing with. It will also give the insurer an idea of how big are their exposures. Businesses that turn over $5 million a year can turn over $1 million to 5 customers. Obviously, the risk of that looks very different to a business that might have 1,000 customers that might turn over $5,000 to each of those customers across the year, because the risk just looks different. The potential loss is going to be much higher. So finally, they'll also look at loss histories. So they will see what is your business, what has been the history of bad debts due to insolvency. So different insurers have different tolerance of those sorts of things. So there's a market out there where some insurers are able to sort of be a little bit more, can accommodate losses more than others. But that's where it sort of comes down to engaging with a specialist, because ultimately a specialist can understand which markets are going to be best suited. But in terms of getting quotes and prices, they're the real key elements. And then it's a matter of us understanding and working with the clients to understand, well, what do you do at the moment? If you have had a loss, what have you changed since you've had that loss? We speak to a lot of businesses that maybe in their growth stage, so sort of younger businesses that have had a loss. And you speak to the directors of these businesses, or you speak to the finance departments, and they've reacted, they've made changes to their internal processes, which we'll talk about a little bit later about what businesses can do, but they've made changes to those processes. Then it's up to us to impress that upon an insurer, that by taking those steps, by taking those measures, the insurer is less likely to have those losses moving forward. So it's very similar to what lots of other insurances are, but what sort of information they look for, but they're really the key parameters and the key metrics that insurers look for.
And with other business risk areas, to some degree, clients will think, if I've already had a claim, and we use cyber insurance for that matter, if you've had a cyber claim, the insurer, some clients would think, would load their insurance premium, would charge a little bit more because they've had a claim. Naturally, as you rightfully said, also for cyber, as you would for trade credit, our role as the advisor would be to explain what it is that they've done since that claim to mitigate it occurring again. Now, do you find most people come to you from a trade credit perspective because they've had an issue in the past and they want to manage that risk moving forward? Or is it something that they're looking at proactively and going, actually, we're carrying quite a bit of debt, or quite a receivable, should I say, or debt, accounts receivables. We need to really think about how we protect against this risk. What do you find the balance is?
It's changed, to be honest. I would say that 5-6 years ago, prior to COVID, the conversations we were having were a lot more with businesses that had just suffered loss. Market operated normally with 7,000-8,000 insolvencies per year, so it was a very predictable trend, I suppose, and growing businesses, young businesses would have a loss, and then they'd want to engage with, how can we protect ourselves against this happening again? The last 5 or 6 years, we've been through COVID, where risks were very high, but actual insolvencies with ASIC were very low, because the government, through various stimulus measures and deferring liability measures, the risk just didn't equate into having insolvencies. Now we're at a point where the bottleneck of that is starting to be released, and we're reading in the newspapers about builders going insolvent. We're reading about hotels and cafes going insolvent. So we're seeing it all the time. So I think business directors or business owners or boards of businesses are now a lot more, I suppose, educated by the general media on wanting to proactively reach out and see, well, what is this all about? So a lot of the inquiries that we get now are from business owners that do want to reach out proactively and say, hey, look, we know that this is a risk. We want to look at what options are out there. And the insurers are very open to speaking to putting together options, more open to speaking to businesses that are in that boat than those that have had losses. It's a hard time to look at the moment for businesses that have sustained losses, because obviously the old insurance metrics of looking at loss history is making it a little bit inhibitive for those businesses. But for those that are proactively reaching out, and there are a lot more now, I'd also sort of say this, I find a lot of the business owners that I speak to, particularly businesses that may turn over 5, 10, 15 million in construction, where the profile of the director that's looking for this, the guys are smart. So they're younger business owners, they're growing their business. And I think they sort of see the dollars that are starting to become involved in these projects. And it's not because they've had a loss that they're looking out for, it's just because they see it, they're educated in the media about the actual risks of this, and they are willing to put things in place proactively, which is great to see, because we don't want to make the phone call, have the conversation with somebody after a loss. It's much easier if we can be having that conversation beforehand.
I 100% agree. It's easy to have the conversation beforehand. But I also find the age-old approach of some insurers saying it's much harder to review a risk when they've already had a loss is one that obviously you and I challenge all the time, because we find when clients have already had a loss, they have experienced what that loss is like, and they know what risk measures to pull on. and they're very clear on what risks they're taking on before they enter into them. I find that an interesting aspect. But talk to us a little bit about the trade credit component, because as I'm aware that you do get access to some tools of which can help this risk effectively, don't you?
Yeah, look, the way a policy will assist a business in the background of the tools, I suppose, it gives a business really comes at the front end and comes in the middle end of credit risks. So what the front end mean is that the insurers, when a policyholder starts a relationship with an insurer, they're working in tandem with the insurer to assess credit risks. Any business will know has got some sort of way of assessing credit risk. Some businesses will make telephone calls to other suppliers. They'll take reference checks. What credit insurance does is credit insurance actually allows you to partner with the insurer who will underwrite that risk for you. And what the credit insurers are doing, that they have access to a bigger database of information than anybody else out there. Credit bureaus exist. So credit bureaus such as Ilian, Equifax, Creditor Watch, they sit there and their product is information. So they'll have court information, they'll have collection information, they'll have director information, they'll have ASIC information. Places like Ilian get fed data from their clients about telling people about how reliable they are at paying. Are they historically overdue payers? So all that information exists out there, but the credit insurers are then buying all that information. So they've got all that information already for clients, and they're vetting, they're doing credit checks on clients' behalf. But in addition, they're bolstering that information. So you think about the example of a QB or an Atradius that are the biggest players in this space. They're running on most building companies out there, or most retailers that are out there, because they're big sectors for this product. They've already gotten, APRA require them to have a lot of information already on these businesses. So they've got private financials of a lot of these businesses. So most commercial and residential builders will be sharing financials with the insurer. It was through the media a few years ago, and Metricon, which is Australia's largest home builder, was perceived to be experiencing financial troubles. There was a lot that was published in the media, and there was a very real concern by the everyday person in the newspapers, on social media, that Metricon were about to fold. The insurers, however, they've got a relationship with the personnel at Metricon. They were able to keep in direct line conversation. They were being given information financial information by Metricon that painted a stronger picture than what was out in the public domain. So what it gives policyholders access to is the ability to trade with big names like that. And this is just an example. It's Richard Crooks was the same a couple of years ago on the commercial side of things, where there was information that was shared, but the insurers have access to these businesses, so they know what's going on under the hood, and they can obviously help steer clients and help clients steer away from losses in the first place. So that's really the benefit, and they continue to write cover. They continue to say, hey, look, you've got $1 million exposure to Metricon. We're happy to keep underwriting that risk, because what we've seen, we don't want you to have a claim, but what we've seen supports you continuing to work to those exposures. We're not going to take new exposure on, because we've seen what we've seen, but to continue to support that and give access to that tool that you can continue to send men to work sites, continue to buy equipment on their behalf to finish housing projects. It's an example that really showed the strength of that tool, of using an insurer to credit check your customers. Now, that's the front end. The middle end of the insurance helps businesses when it comes to pursuing delinquent debts. The insurers, at the end of the day, we touched on earlier, they don't want claims to be paid. Clients don't want claims to be paid. So what the insurers will do, the insurers gives the client a stick. They give them a stick to wield, and that's designed for them so they can chase up the clients. They can use things like collection agents. They can use solicitors, and the insurers will cover those costs for them to do it, because ultimately, putting in good practices and putting in disciplined practices in doing that is ultimately going to lower the chance of a claim. So the insurers help chasing the delinquent debts in the middle stage. Now, obviously, at the end stages, they will pay claims. So that is where the end sort of fits. But really, the tools for a client, the claim payment's the byproduct of everything, should all else fail. But the tools for the client is really is in that upfront stage where they're able to make informed credit decisions, because the insurers have more information than anybody else in the market at the moment. We have a fairly established market in terms of capacity. We'd love more insurers. There's definitely a place for more insurers to do more work, but there's enough capacity for businesses now to partner with insurers who can take on those big risks. And then certainly the other tool is definitely that middle stage in clients not wanting to go down the legal route to pursue money for cost reasons because the insurers are going to cover the cost for them.
And so a lot of the examples that we talk about are sort of big company examples, Richard Crooks, Metricon, you name it. But what about the SME businesses? How accessible is this product for SME businesses? Do you see businesses sort of sub $5 million, sub $1 million? Where do you see that trade credit really becomes applicable? Naturally, it's industry dependent.
Yep.
But what size is it relevant and not relevant?
Yeah, look, there is a sweet spot. Businesses that are too big can generally afford to wear a loss themselves. So a lot of businesses that we engage with, turnovers of more than, say, 200 million, they've got the financial setup of this. They're financially stable. They can cover a loss like that. It's businesses really in that sweet spot of 1 million to 50 million to 70 million that really operate in this area where any loss that they're going to incur has the potential to really be felt. I mean, if you're talking a business that writes off $200,000 a year, that business turns over $2 million. That $200,000, that's 10% of their. If the business operates on 20% of the margins, the director's going to work for the next 6 months just to pay off that $200,000 loss. So the sweet spot really for businesses that feel the effects of a bad debt, really we find and who we partner with settle within that 1 to 50. Now, in terms of where businesses start to engage with credit insurance policies, the market's got a lot better in terms of giving solutions and access to the policy product for small business. And it's done that not only in price. I mean, I've been working in the industry now for 10 years and minimum premiums have decreased over that time. So we're talking 10 years ago, minimum premiums $15,000, $16,000 for a business to access credit insurance. So $1 million businesses, that's 1.5% of turnover, which was made it fairly inhibitive. We're now at a point where minimum premiums are $8,000 or $9,000, depending on what sector you're in. And it does start really becoming a worthwhile consideration for businesses that turn over more than $1 million, because any less than that, it's the cost effective. We still got to work. But it's also improved in terms of, well, what does the client actually have to do to manage a policy? So they've made it SMEs. The market doesn't want SMEs to think there and say, well, that's great, we can get it. The price is fine, but we're going to have a solution that's going to be too difficult for us to manage. You're a plumber, you're running guys off around to work sites, you've got an office person that looks after your finances. We're not going to be able to manage our book in terms of when comes claim time, we're going to have issues. The insurers really are taking back what's required and they're making it easier for businesses to operate within compliance of a policy. So there's the price element that they've really improved for SMEs, and there's also the compliance element that they've improved for SMEs. In terms of industries, I mean, you can look at the ASIC keep very open statistics about insolvencies. We touched earlier on the numbers, but the industries that are consistently represented are construction, hotels and retail, hospitality and cafes, and retailers. So they're traditionally the three that will definitely be, looking after more than 50, 60% of insolvencies. There's new industries, though, that we are seeing more representations from. So we're seeing it from transport, particularly margins very low. So the transport industry are really under stress. Manufacturing's under stress, and so's the IT sector. So there is a bit of a shift from those traditional industries that look at this to other sectors now that are just purely by the insolvency numbers starting to look at, there's opportunities there. So there's more open to SMEs, and there's different sectors now certainly have a need just with the changing economy.
And would you say there are any challenges with managing the product per se from a servicing perspective? Or
Yep.
Naturally, that's why you would work with an advisor, but what are some of those challenges?
Yeah, look, we see clients come unstuck from time to time. There needs to be, internally within a business, there needs to be knowledge of what the processes are with a policy. The policy requires you to work with the insurer. So when you onboard a new customer, you need to be getting those credit checks and doing that due diligence with the insurer. So you need to be requesting cover from the insurer, because if you come to the insurer, 6 months after incepting a policy and you say, look, I've just had a loss for 300,000, and the insurer says, well, have you added that customer to your policy? No, we haven't. The insurer doesn't have liability in that scenario. So you are required internally to make sure that as you pick up new customers, now they make it easy for you. They allow you to keep customers on there. So if you put your customers on at the start, you don't have to take them off, or you don't have to increase. They let you operate as easy as they possibly can and say, look, you might deal with Richard Crooks once or twice a year. Have $500,000 cover, leave them on there, so when you need it, you've got it. You don't have to take it off when you're doing it. So they do make it easy, but businesses just have to remain vigilant that they are doing the basic steps right, which, to be honest, the requirements are what any business should be doing anyway. Clients need to stay on top of not trading past terms. The insurer sits there and they give clients license to operate normally out to 90 days, sometimes out to 120 days. And that gives the clients a flexibility to deal with customers who are late in paying them, but don't deal too late with paying with customers. So business directors that operate have to be conscious and always checking, well, we're in August now, have we been paid our April invoice? If we haven't been paid our April invoice, that's a problem, right? So there is that element that you have to remain on top of it. That's one of the challenges. I'd say, capacity is one thing that we'd love to see more insurers in the market, giving us the ability as brokers to give clients access to cover. As we're seeing more interest in the policy, we want to be able to go to customers as much as possible and say, you've got 15 customers you deal with, we can cover all 15. In an ideal world, we'd be able to deliver that. It's not always the case because they've got parameters internally that don't allow that. But that's one of the challenges that we sometimes come across. But yeah, I'd say provided businesses are there are claims issues, and they're primarily why the claims issues come up, because businesses don't stay vigilant. They're not as on top of credit management as they should be. But there's different things we can assist them with, doing monthly reconciliations of what cover they have versus what they're exposed to. So as brokers, we've got the capacity to assist and help with that. We just need clients to talk to us. And
from a pricing perspective, you said the minimum premiums now for SME clients are sort of $8,000 to $9,000.
Yeah.
How is this priced generally? Is it a percentage based on total amount outstanding, or how does it work?
It's traditionally been a product. It still primarily is a product that's done based on revenue. So we sort of touched on it earlier. It's annual turnover on credit. So businesses will nominate what their forecasted sales are. The insurers will look at the risk profile of that. They'll provide a percentage, and then they will charge a premium alongside that. So that's traditionally how and then at the end of the year, if there's greater turnover to be accounted for, they'll pay a reconciliation up. If it's less, you can get refunds if it's less than you forecasted. The new SME products that the insurers have out there are fixed premiums. So they know that if you're running a small business, it can be hard to forecast exactly what you're going to turn over. So they'll work with us to say, well, look, you work out what's a fair and reasonable number, and we will price it a fixed premium. So there are improvements throughout there. Likewise, there's now insurers that are engaging more with clients on covering single risk or named risk. It's a pretty standard question we've had since I've been working in this product, where a business will want to engage with us and they will say, look, I've got one customer. During COVID, when retail stores were shutting, the amount of calls we'd get from clients saying, I need Myer or David Jones covered, because every second day there was newspaper articles being written that Myer and David Jones, because of stores shutting, what happens next? Businesses had huge exposures to those businesses. Are we going to get paid? Are they simply going to pull the pin? And big department stores have gone broke. This wouldn't be the first one to go broke. The amount of queries we were getting where, can we get this individual risk covered? Back then, the product didn't necessarily have a solution for that. We are getting more and more insurers now that are open to considering single risk type cover. Whether it's the most cost-effective way of doing it, that's what quoting and engaging with a broker will get you to. Is it the most cost? Maybe, maybe not. But there are now avenues out there for businesses to be more selective on how they want to structure things. So that and then those solutions are based on an exposure. You'll purchase an exposure off the insurer that you'll say, I could be exposed to $3 million here or $2 million, whatever it might be. And then based on that, the insurers will give you a premium based on that.
Yeah, there's quite a lot that goes into it naturally. So it's not always easy to ballpark what that's going to look like.
It doesn't take too long a phone call to give people an idea about what the premium. The hard thing is covering the risk, because the insurers have got the ability to provide feedback on buyers.
On what that and what that might look like. And they've got information that you don't necessarily have access to. Now, talk to us about, you might not have the exact percentage, but the percentage of clients that choose to self-insure versus use trade credit, right? Because trade credit insurance really is a tool, right? A way to manage risk, a way to transfer risk to an insurer. But we know a lot of clients that come across our desk decide to self-insure, in some instances to their detriment. But would you have any statistics around that?
Yeah, look, I would say market penetration is very low, to be honest, I think. In the areas where you think I would say in construction risk, which is where subcontractors are working for builders, that would probably be where you would see the largest portion of people operating insured. Statistics are hard to come by, because insurers generally are pretty closed book about, well, what's my premium pool versus, they don't want to give away too much information. I'd estimate that the premium pool paid to us to insurers in Australia is about 350 million. So it's not a huge amount of businesses that insure. We speak to a lot of businesses post-insolvency. So when a business goes broke, we will start engaging with businesses that lost money. Through those conversations, I would sort of say in that construction space, I'd say would probably be at about 35% in that sector would be insuring, but that would be the highest industry. It's growing, because there is now, as I sort of said, there's more education out there. It's more mainstream media now, and people are starting to see the effects of insolvencies. Insolvency numbers are double, so while ever that's as high, the number of businesses getting insurance is increasing, but it still is I'm often, like you, very surprised when I speak to businesses that have lost money, the amount of businesses that don't know about this policy. The cover's big in Europe, so a lot of banks in Europe will mandate that you have trade credit insurance. It's not as big in America, so we're sort of caught in between those two. The finance world, the banking world over here doesn't have as bigger insistence as what it does in the UK. But in saying that, it's something that's growing, and I think it can only really grow at a rate where it's got an insurance market behind it that can support it. So it is a slow growth, but I think over time it will continue to, while ever the insolvency laws remain in Australia the way that they are, and we're seeing and the number of businesses growing and the number of projects and the economy growing, this will grow with it.
And not to say that it is directly related to interest rates, but often we find business owners are taking more risk depending on how the economy is tracking, right? And so I personally think trade credit allows them to take on more risk, really. And so it's, again, a tool of which they can utilise. Out of interest, do you have any claims examples that you can share with us?
Yeah, look, claims, it's an interesting one. Again, every case is quite unique. Insurers, I mean, the easiest claim examples are the ones to talk about where insurers have been able to steer clients clear of dealing with particular customers well before an issue happens. I mean, there was a business last year, 12, 14 months ago, National Projects, that was a builder that operated commercial builder that operated across the eastern seaboard, had a history of slow payments. So insured policyholders were familiar with that. The insurers were telling them from a long time. And not only that, there was the history of directors within that National Project business had history with other failed entities as well. So insured clients with a policy were wanting to deal with those customers, but the insurer was saying no. And in the end, they did go insolvent, owing $20, $30, $40 million to creditors. So from that side of things, that's an example of insolvencies where the data in the markets helped steer people clear of that well before it's happened. The example, you can talk about the benefits of insurance in terms of being proactive about chasing overdue debt and where clients have won from there, because we've seen clients that have had big money owing been proactive on collecting that money because their insurer would pay the solicitors to chase that. Solicitor chase the debt, our client gets the money back, then the customer goes broke. But in Australia, the way the insolvency laws work is insolvency practitioners have the power to go after creditors for preferential payment. So essentially what preferential payment's designed to do is say, well, this plumber was paid in preference to anybody else. This business went broke in December. The plumber got paid in November and October when nobody else got paid in November and October. So the insolvency practitioner will come along and say, dear plumber, I want the money back that you were paid in November and October because the electrician, the roofer, the concreter, they weren't paid. So they should therefore get some of that money back as well. Insurers will cover you for that loss, but it's an example of even when you act proactively on trying to chase debt, you can still get stung by insolvency practitioners. So the real benefits, claim examples are when insurers predict before things are going to happen. But on the flip side of that, there's a lot of established bureaus out there. Clients can get their own credit bureaus. They can pay subscription to credit bureaus that will claim to be able to give people this heads up advice beforehand, and they can get similar sorts of heads up elsewhere. The value really is when something does go wrong down the track that they get a claim, because sometimes information out there can't predict it. Then,
And out of interest, those costs that the insurer helps with by covering to chase, is that included in the claims history?
No, it's not. When insurers look at it, they're only looking at pure losses due to claims. Those costs aren't included in the assessment.
Yeah, I presume there's a cap on the amount of costs that you can.
They are, but they've recently moved, so they've gone from a $10,000 to a $15,000 cost collection, which very rarely, where the debt's bona fide. $15,000 per matter. So the cost to wind up a business can be $6,000-$7,000. The legal cost preceding that can be $6,000. So very rarely, where it's clear-cut bona fide debt, undisputed debt, would we see costs go above that. So they've got a big war chest to play with in terms of covering those costs.
Okay, cool. And then sort of thinking beyond insurance, what are some of the practical steps that I guess some small to medium enterprises can take to protect their business from receivables? First of all,
there's a lot of business, especially in the small to medium space business, that don't have the right terms and conditions set up front. So they'll get to a point, they'll want to pursue their rights, they want to get their money back, but they don't have the correct documentation up front to then go and try and enforce those rights upon somebody. It is always worth spending money with a solicitor. That's not something, it's not something we have the ability to do, but spend money with your solicitor, get your terms and conditions right to stop issues coming up down the track. Because where we're operating in a cash short market, interest rates are high, businesses are struggling, so are your customers are struggling with costs as well. And if they can wriggle out of something because they've seen you've got poor paperwork or poor terms and conditions, they'll do it now. So if you're a small business, you need to make sure you take the appropriate steps up front to have your terms and conditions set correctly. You then need to know who you're dealing with. So are you dealing with a trust? Probably not, because if you need to sue that trust, you can't sue that trust. You'd be dealing with a trading entity. So you've got to take this information, get a credit application. You don't need one for a policy, but they're very handy when it comes to enforcing your rights, and it lists who you're dealing with. It lists the ACN, it lists the director's details. So know who you're dealing with. But secondary to that, do some sort of checks. If you don't have a credit insurance policy where a credit insurer is doing all that for you, do something. Trade references these days, a lot of people we speak to, if you're going to be giving a trade reference on yourself, you're going to be giving referees that know you pay them on time. But there's a lot of bureaus out there. Creditor Watch is a popular one that give you access to information about how well is somebody paying somebody else. Are their defaults listed? So get a subscription to one of these services. Get a subscription to Ilion, because these types of bureaus, sometimes for the cost of $40, $50 a report or a monthly subscription of $200, can help you share in a pool of information that can help you know who you're dealing with, that you're dealing with somebody who is reliant on paying you. And then finally, just be diligent in your processes, be consistent in your processes to chase debt. Too often we see businesses that have practices that are built around mateship, or they've operated for a long time and they've let slack go too long, and they get taken advantage of too often. You have to be consistent in terms of when do we cut supply. The best businesses that have the least losses is cutting off supplies once a customer's overdue. So that might be once somebody's 30 days past due, stop working, get the money back. Don't allow poor practices. Now, ultimately, that's going to be a different balance point for every type of business. Each director is going to want to operate with more rope or a little bit more flexibility than others. But at the end of the day, you have to be thinking about it, and you have to be consistent, and you have to be disciplined. So not spending the insurance money, those are the real steps, and they're basic steps. They're things that, with accounting softwares, sending out regular reminders, accounting softwares, MyOb, Xero, they're set up to do that. So you should be able to, without even raising a sweat, be able to stay on top of reliable practices.
Some great advice there, I guess, for any business owner to take into, I guess, one, protect their business from insolvency risk. And that's not just insolvency of their own business, it's insolvency of customers that they deal with. So I appreciate that.
No problem.
I'd love your outlook on the future, really.
Yep.
There's a whole bunch of conversation around interest rates and movements being downward, inflation, differing lending conditions. How do you see that impacting insolvencies in 2025 and beyond?
Yeah, look, it's an interesting question. It's something that's really been fluid over the last 18 months, 3 years, even with the challenges that we've had. The challenges are now changing. High interest rates have been around for a long time. Access to capital has been difficult now for some time. So businesses' ability to get out of tricky spots is harder. Looking at the statistics of where we are now, there were over 14,500 businesses went broke in the 2025 financial year. We were talking 11,000 in the year before that. We were talking 7.5 the year before that. So if you're looking back over the last 2 to 3 years, it's been almost a 200% increase in insolvencies. Now, the baseline insolvency stats for what ASIC has been taking these statistics for 25 years, the baseline insolvencies is around 7,500. So we are at levels now that are very, very high. The expectations are that they have plateaued, but they will remain high. So there's not the July numbers for 2025 were 10% up on the July numbers for 2024. So worryingly, if you continue to extrapolate that, we're looking at 16,000 insolvencies for the 2026 financial year. The data that's in the market, that the ATO is the biggest creditor to Australian businesses. They're owed more money than anybody else. They're collectible tax debt. So what that basically means is money that's due and collectible it's 50 billion, which is more than double what they're comfortable operating within, which causes a problem because if they decide to get in a mood where they want to start enforcing their rights and they are becoming less open to payment plans. If you owe the ATO money now, it's a different conversation than was in the middle of COVID. If you owe the ATO money during COVID, all sorts of allowances were given to you. You want to have a conversation with the ATO about paying overdue debts now. If it's not done, in some cases within 4 to 5 months, the businesses are being wound up. So that's got a little bit to play out, probably over the next sort of 6 to 9 months. I wouldn't really like to predict much beyond the next 12. I do think the next 12 we will remain stubbornly high, and I think we will continue to see more insolvencies at that highly inflated level. So we're talking 16,000 insolvencies a year, and the types of insolvencies are ones that are across a number of different sectors. I particularly think in transport and logistics, claims are going to continue to grow. IT, manufacturing, they will keep growing. Construction and retail, construction and hospitality, I hope will plateau. That's the general feel that we're getting. As tariffs and things like that change and people continue to deal with high interest rates, they don't have the money in their pocket anymore to go to restaurants and everything as regularly as what they did. So I do think the next 12 months, I would expect things to continue to be high. Hopefully after that, we get a little bit more of a normalisation, but we'll see. Australia's growing. With growth comes challenges. So, yeah.
Perfect. Ian, there are two camps of people that will listen to this podcast. There are people who are business owners who are considering what their risks might be, and there are insurance professionals who, have a number of clients that they are advising. And And I think there's a lot of juice and a lot of value in what you've provided today to push trade credit, really. I agree. I think it is underutilized. I think the market penetration is quite low, and there's some room for growth. Business owners are growing their appreciation for what the risk is, and I look forward to that trade credit insurance space growing. Thank you for coming on the show.
Thanks, Will. Thanks for having me.
Look forward to chatting again.
Good. Awesome. Thanks, mate.